This is a huge win for mortgage consumers in Canada as OSFI announced, finally, after years and years of trying to make this come together, there is no longer a stress test for those who are making an uninsured switch on their mortgage at the end of maturity. Now hold on, before you leave the video, let me explain what the heck an uninsured switch is, the history and why it's important to you, what's coming up and how this could save you money. You're going to want to know this because most people completely miss out on this option when it comes to mortgage renewal. So let's break it down. What is the big deal and what does it actually mean to Canadian consumers? If you've ever had a mortgage renewal, or even if you haven't yet, here's the thing. At the end of that mortgage renewal, traditionally speaking, you have to qualify at a rate of 2% or 200 basis points above the rate that you're actually taking. Now, as you can imagine, this protected a lot of families in 2021 and 2020 when rates were rock bottom. But as we hit the end of the year 2023, it was just straight up restrictive for people who are trying to find better options and restricted to staying with their own bank despite the fact that they can make the monthly payments and service them themselves. So what exactly was the actual official word from OSFI? Let's break it down and then we'll talk about what this means to you and how it's going to save you some money. First of all, starting on November 21st, OSFI will no longer require the MQR for straight switches of uninsured mortgages. MQR is the minimum qualifying rate, otherwise known as the stress test, the 2% thing that I just mentioned a minute ago. A straight switch means your mortgage stays exactly the same, essentially meaning if you have $450,000 with 28 years remaining on your amortization, you're going to take that and move it over to another lender with the same terms and usually same amortization, but there is some flexibility under that. But the big thing here is you're not refinancing and re-extending the amortization past the original amount or taking out new money or extra money. But typically speaking, when you're doing a switch, you have the ability to add $3,000. And this is notable because it means you don't have to stay with the same lender, you don't have to stay with the same products that you had before, and in some cases, you can look for more competitive solutions when you're moving your mortgage somewhere else. So why did they make this change, and why have mortgage brokers been pushing for this change since 2018? Well, starting off quite simply, it is basically leveling the playing field to start things off. Essentially, as things are right now, or as they were, I guess, depending on when you're watching this video, there was a massive discrepancy between an insured option for a borrower and an uninsured. Remember, an insured option is a mortgage that someone took out originally where they bought CMHC insurance for less than 20% down, or they qualified through insurable guidelines, so under $1 million, less than 25-year amortization, not a rental property, and so forth. Anyways, up until November 21st, people have had to basically go with higher cost and more expensive options, and again, qualify via the stress test. Now, as of November 21st, what will happen is not only will people have the ability to switch to a different institution for their products, but in addition to that, they won't have to qualify at those higher monthly payments because they've shown an ability to actually make the payments at that previous lender for a period of time. This impacts how much income that you need to show for an application, and obviously how much money you can borrow, which is going to be huge news for people looking for more competitive options. And we'll break that down in just a second here. So why did OSFI actually end up making the change itself? Well, the reality is over time, they were able to prove that there was no negative impact, or I guess positive impact in this case, of having a stress test in place for those coming up for renewal. It was just limiting competition and options. The average Canadian still has to qualify to get their mortgage with a stress test at 2% above. So they've gone through that, and the minimum stress test for years has been 5.25%. And so it really only negatively hurt Canadians, or impacted Canadians specifically in 2023 when rates were around the 6 to 6.5% price point and plus. Now with rates declining, this obviously won't be as impactful to the average Canadian. We can only hope that it is not impactful at all when it comes to rates continuing to go back down. For other Canadians, however, it is something definitely notable. Now, the data itself is impactful and important, but let's talk about what the actual impact is to you as a borrower in terms of real life numbers. So I'm going to walk you through a real scenario of $300,000 mortgage. So as of today, just based on some general guidelines, on a $300,000 mortgage right now, you'd have to qualify with income about $81,300 on an uninsured mortgage. Now, keep in mind there's variances to the high and the low, but that is the number that you would typically use for a standard qualification. After this, you would require income of $71,000, which is a 12.7% reduction in income. Obviously, the higher the mortgage amount, the more impactful this actually is when it comes to your mortgage qualification. Now remember, this doesn't necessarily mean you're refinancing, but again, you're switching, so it gives you those options. And with a lower amount of income to service the debt, assuming you've made your payments, why not? Why can't we make this change? So let's talk a little bit about the primary purpose of this is actually, well, not just rates, but competition. It's going to provide more competition in the marketplace for consumers, which is only a good thing. And we estimate that as of today, the rate reduction could be anywhere between 5 to 1/4% on average reduction for someone making that switch. Plus, I mean, it also opens up options if that person wasn't happy with their existing lending institution they're working with, or they wanted to move somewhere for other reasons outside of just the rate itself. Now, the actual savings could be on a $300,000 loan, $1,400 over the course of a 5-year term, and that's for $300 grand. And that's kind of a conservative estimate. The number could be higher, but let's be honest here, saving $1,400, saving $2,800, or saving more is impactful for anyone for that matter, notwithstanding the changes of programs or products. Now, a few years ago, looking in the history of CMHC, they made a variety of different changes, and these rules have just only gotten more strict and confusing as time's gone on. So we have to kind of backtrack and look at when were these rules even put in place, right, as a consumer. In 2016, the biggest change took effect from CMHC, which is when they raised the premiums for buyers with less than 10% down. Now, this obviously impacted people when it came to purchasing properties with less than 20% down. As a side note, if you were someone who purchased a home and it was insured and you keep switching your mortgage, that insurance has stayed with you for the entire time of your loan, which essentially means that you could save money and have better rate options at the end of your term. Now, some of the other changes in 2018 was when the stress test was implemented on all mortgages, not just variable rate loans, which were the case before. Obviously, that had a significant impact in the marketplace. And for about 6 to 12 months afterwards, we saw the impact on what people would qualify for and buy at that time. 2020, during the pandemic, there were some significant tightening points for CMHC when it comes to the minimum credit score and other requirements. And this is one of the things that really pushed first-time buyers out of the marketplace. And of course, in 2021, there was a reversal of some of those rules and changes. And here we are today with a combination of rule changes from the $1.5 million price point for less than 20% down, these switching guidelines, and these new rules for under 20% down 30-year amortizations. It seems that CMHC is now trying to open up demand and recognizes that most people can, generally speaking, make their mortgage payments. They just need the ability to actually qualify and get in the marketplace in the first place, and competition is a good thing. So why this matters now more than ever is because there's this talk of a debt cliff coming up. For all those people that took mortgages in 20, 21, 22, they're coming up for renewal very soon, 1, 2, or 3 years from today, and they're all going to be faced with a challenge. Do we stick with our existing lender? Can we switch to different institutions? Will there be competition in the marketplace? And it's going to be an absolute frenzy. This news right here is going to be positively impactful for those people coming up for renewal, and is just another reason that you should be talking to a mortgage broker to source your lending options there for you, so that you can now start to look at other lending options that can be more competitive. Now, some big questions still remain at this point right now. One of the big questions is, will CMHC allow lenders to bulk insure loans to offer even more competitive discounts at a lower cost? As it stands right now, the uninsured market is basically owned by banks. Like, it's 100% owned by the big banks. And if you think that's a good thing, think again. These multi-billion-dollar profit companies are here to make money, let's be honest. And having only a few options, Canada, the big five, eating up a vast majority of the marketplace when it comes to uninsured loans, is not good for consumers. In fact, it's terrible for consumers, and it reduces the amount of potential competition in the marketplace. If CMHC opens up and allows that bulk insurance up to $1.5 million, it's going to allow a number of other lenders to enter the channel, and it's going to completely change the benchmark when it comes to lending and options, forcing virtually every lender to be more competitive and allowing people to have more options available to them, not just the rate, but also the different guidelines, lenders, rules, and just general speaking experience and service. These are questions that are yet to be answered, but we're hoping to be answered very soon, and we hope to provide you with another update on that news. But before you go, my final thoughts really quickly is I'm happy, hats off OSFI for making a change that actually benefits consumers for once. It could have come down, 5 years ago, but it came down today. Sorry, Chewy. And at the end of the day, it's a good thing. Now, if you're up for renewal or your mortgage is coming up for renewal in the next 6, 12 to 18 months, make sure to send me a note below. We have a mortgage monitoring software to show our clients where they stand today and the best options that are available. All our clients get access to this, and if you'd like to be one, then send us a message. All the contact details are below.